welcome to this deep dive. So today we're getting into recurring deposit accounts, RD accounts.
Yeah, RDS.
We've got some good material here, explains what they are, how they work, some examples, even the math.
Right.
And our mission really is to, get a solid grasp on these. What are they for? Why use one? How do they calculate the payout? But keep it straightforward, no heavy jargon.
So good. Yeah, clarity is key. And to really get RDs, maybe it helps to step back for a second. Think about, well, what banks actually do.
Okay, yeah, good point. Banking basics. So what's the absolute core function?
Well, fundamentally, a bank is a place that takes money in from people, businesses, whoever wants to keep it safe, and maybe earn a little interest on it.
Right. Safety and maybe some earnings.
Exactly. And then they take that pool of money and lend it out to people starting businesses, maybe needing funds to expand, or for personal loans.
And the bank makes its money. How? On the gap.
Precisely. They charge borrowers a higher interest rate than they pay depositors.
Right.
That spread, that difference, that's a big part of how they operate and profit.
Makes sense. But, banks do way more than just hold deposits and make loans, right? Our sources mention other things.
Oh, absolutely. That's just the core. Think about payroll.
Yeah.
Lots of salaries go straight into bank accounts. Banks handle that. They handle money transfers to help you pay your bills.
Okay. Yeah.
Then there are things like safe deposit boxes, lockers for valuables. They deal in foreign currency if you're traveling. And of course, all the cards, ATM, debit, credit cards, a much wider net of services.
Right. So that paints the bigger picture of banking. Now let's zero in on these recurring deposit accounts. Within all the deposit options, what makes an RD stand out?
What's really characteristic of an RD account is the discipline it encourages. It's about regular, consistent saving. You don't need a big lump sum to start.
Okay.
Instead, you commit to depositing a specific, fixed amount of money every single month.
Every month, same amount.
Yes. And you do this for a fixed period that you choose right at the beginning when you open the account. Could be, say, 1 year, 3 years, 5 years, whatever options the bank offers.
So it's almost like a structured savings plan you set up for yourself.
That's a great way to put it. A forced savings mechanism almost. And the payoff comes at the end of that chosen period. You get a single lump sum back. That's called the maturity value.
Maturity value. Got it. And what actually goes into that final amount?
It's basically two components. First, the sum total of all the monthly deposits you faithfully made over the entire duration.
Okay, so everything you put in.
Right. And second, the interest that your money earned while it was sitting in the account.
The interest. Now, how is that calculated? Is it simple interest?
Good question. No, it's typically compounded. And specifically for RDs, our sources say it's compounded quarterly.
Quarterly. So 4 times a year, they figure out the interest and add it.
Exactly. They calculate the interest earned up to that point and add it to your balance so it starts earning interest too. The rate itself is fixed for the whole term you chose.
Fixed rate. Who sets that rate?
Well, the sources mentioned it's determined and revised periodically by the Reserve Bank of India.
India's central bank. Why them?
Yeah. As the central bank, the RBI oversees the financial system. Setting benchmark rates for certain savings products like RDS is, well, it's one of their tools for managing the economy and ensuring stability in the banking sector.
Okay, that provides some context. So fixed rate, compounded quarterly. Now the math. Our sources give a formula for the interest. Can we break that down?
Absolutely. Let's look at it. The formula to calculate the total interest is DWP times plus 1 times stress.
Oh, okay. Let's unpack that. P is?
P is the fixed amount you deposit each month, your monthly installment.
Right.
N is the total number of months you're making these deposits.
Yeah.
So if it's a 3-year RD, N would be 3 times 12, which is 36.
Got it. And R must be the interest rate.
Yes, R is the annual interest rate, expressed as a percentage. That's why it's divided by 100 in the formula.
Okay, P, S, N, R. Monthly deposit, number of months, annual rate. But what about that middle part? The N plus 1 divided by 2 by 12, that looks specific.
It does, yeah. Let's think about why. The N plus 122 part, that's actually related to the sum of the first N integers. But here it's effectively weighting the deposits.
Weighting? How so?
Well, think about it. Your very first deposit sits in the account for the following months, right? It earns interest for the longest time.
Okay.
But your last deposit, it's only in there for 1 month before the RD matures. It earns interest for a much shorter period.
Right. Different amounts of time for each deposit.
Exactly. So that freight 10 plus 1, 2 part, combined with the division by 12 to relate the number of months to the annual interest rate R, essentially calculates an equivalent number of months that the entire principal sum is effectively held to generate the total interest earned, considering the staggered deposit timings. It averages out the interest earning period for all your deposits.
Okay, that makes more sense than just seeing the formula. It counts for the timing. So once we calculate I, the total interest, using this, how do we get the final amount, the maturity value?
Simple addition then. The maturity value, or MV, is just the total amount you deposited yourself, which is P times N.
Monthly deposit times number of months.
Right. Plus the total interest I that we just calculated using the formula. So MV equals P times N plus I.
Okay, P times N plus I. Got the formula, understand the parts. Let's make it real. The sources have examples. First one is Kieran.
Yes, Kieran. The details were a monthly deposit, P, of 200.
Okay.
The period N was 36 months, so 3 years.
36 months.
And the annual interest rate, R, was 11%.
11%. Okay, so we plug those into the interest formula. 1 equals $200 times 300 times 36 plus 1, 2 times 12 times 400.
Which simplifies to $200 times 36 times 37 times 400.
Right. And the calculation in our source gives the interest I as 3,221.
Correct. That's the interest earned. Now, how much did Kieran actually deposit in total?
That would be €200 a month for 36 months. 200 times 36, 7,200.
Exactly. So the final maturity value Kieran received is that 7,200 plus the 1,221 interest.
Which comes out to 8,421.
Precisely. A clear example of how it adds up.
Definitely. Let's try another one. Mohan, different approach here. Smaller deposits, longer time.
Right. Mohan deposited only 80 euros per month. So P is 80.
Okay.
80, but he did it for 6 years. So the number of months N is 6 times 12, which is 72 months.
72 months, long time. And the rate?
The annual interest rate, R, was lower in this case, just 6%.
Okay, so P80, N72, R6, plug it in, $1, 80 times 5,002 times 72 plus 100.
That's $80 for 72 times 500. And the calculated interest, according to the source, is 1,051.20.
1,051.20. Now, total deposited by Mohan, 80 times 72 months. Let's see, 5,760.
Correct, 5,760. So it's a maturity value.
That would be the 5,760 plus the interest of 1,051.20 gives 6,811.20.
Exactly. And it's, interesting. Even with a smaller monthly amount and a lower rate, that longer time frame, 72 months, really lets the interest accumulate. Time is a powerful component here.
Yeah, consistency over a long period really pays off. Okay, next example. This one flips it. We know the end amount and need to find the start amount, the monthly deposit. Mr. R.K. Nair.
Yes. For Mr. Nair, we know the maturity value, MV, was 6,455.
Okay.
The period N was just 1 year, so 12 months.
12 months.
And the annual interest rate, R, was quite high at 14%.
14%. Wow. Okay, so the question is, what was P? How much did he deposit monthly?
Exactly. We need to work backwards using the full maturity value formula. MV, P times N, plus P times fractal plus 1 times 12 times fractor.
So we plug in everything we know. $6,455 plus P times 12 times fractal. P is the unknown.
Right. It becomes an algebraic equation to solve for P. You'd simplify the terms with N and R.
And the source walks through that algebra.
And finds that P equals 500.
So Mr. Nair was putting in a 500 each month.
That's what the calculation shows. It demonstrates you can use this to figure out the required saving amount if you have a target maturity value in mind.
Very useful. Okay, couple more variations. Ahmed's case, he knew his deposit and the final amount, but wanted to know the interest earned and, crucially, the rate.
Yes, Ahmed deposited a larger amount. P was $2,500 per month.
2,500. Okay.
He did this for 2 years, so N is 24 months.
24 months.
And his final maturity value, MV, was $66,250.
Right. So, first step, finding the total interest paid. That seems easy enough.
Yeah, pretty straightforward. You figure out his total deposits first. 2,500 times 24 months.
Which is 60,000.
Exactly. And since he received 66,250 back.
The difference must be the interest. 66,250 minus 60,000 is 6,250.
Correct. 6,250 is the total interest I.
Okay, so we know I, P, and N. Now we need to find R, the rate. How do we do that?
We go back to the interest formula. 1/2 P times fresh N plus 1. We know I is 62 for 50, P is 2,500, and N is 24.
So $250 equals 2,500 times frac per 24 times is the unknown.
Precisely. Again, it's algebra. You rearrange the equation to isolate R.
And when you solve it, the source shows
that R comes out to be 10, so the annual interest rate was 10%.
Being able to calculate the rate you actually got is really valuable. Okay, last example, Monica. She knew the deposit, the final sum, the rate, but not the time. How long did she save for?
Right. Monica's monthly deposit, P, was $600.
600.
Her final maturity value, MV, was $24,930.
Okay.
And the annual interest rate, R, was 10%. The unknown here is N, the number of months.
This sounds like it might involve more complex math, maybe, according to the source material.
It does a bit.
Hmm.
When you set up the maturity value equation, phi times n plus 2 times 12 times frac and fan, and plug in Monica's numbers.
So 200, more $100, $930, 600 times n, plus 600 times 12 times brand.
Yeah. When you simplify that equation, you end up with n appearing as both n and n squared. That makes it a quadratic equation.
Quadratic. Okay. Requires a specific method to solve.
Correct. The source shows the steps. Often, quadratic equations give you two possible answers for n.
And in this case?
One answer turns out to be negative, which doesn't make sense for a time period.
Can't have negative months.
Exactly. The other, positive solution, is n, 36.
36 months. So Monica's RD was active for 3 years.
That's right. It really shows the power of understanding the formula you can solve for pretty much any piece if you know the others, whether it's the final amount, the interest rate, the monthly payment, or even the time needed.
Okay, we've gone through the basics, the formula, a lot of examples. Let's try and boil it down. What are the really key takeaways for you, our listener, from all this?
Well, I think the main thing is that RD accounts are fundamentally a tool for disciplined saving. That regular monthly commitment, it really builds up over time.
Yeah, that consistency seems crucial.
It is. And the final amount you get back, your maturity value, it directly depends on just three things. How much you put in each month, how long you do it for N, and what interest rate you're getting.
And knowing that formula, even if you don't, calculate it by hand every day, it gives you a feel for how those pieces interact. A higher rate helps, more time helps, bigger deposits help.
Exactly. It empowers you. And like we saw with Mr. Nair, Ahmed, and Monica, you can use that understanding to plan. If you have a goal, say, saving $50,000 for something in 3 years, you could estimate the monthly deposit needed, assuming a certain interest rate.
Or figure out how long it might take to reach a target with the amount you can save each month.
Precisely. It makes saving less abstract and more about concrete planning.
So fundamentally, you should now have a pretty clear picture of recurring deposit accounts, what they are, how they work, the mechanics behind the returns. It's a relatively straightforward savings vehicle, but one that rewards consistency.
Which really brings the question back to you, the listener. Thinking about your own financial plans or goals, could an RD account fit in? Could be a useful strategy for, say, a down payment, maybe education costs, or just building a safety net, something to consider.
Definitely food for thought. And, the world of finance is packed with these kinds of mechanisms and tools. Are there other areas of banking or maybe personal finance in general that you find particularly intriguing or confusing? Perhaps that's a topic for another deep dive.
Could be. There's always more to explore.
Indeed. Well, thanks for joining us on this exploration of RD accounts today.